Hi everyone, I'm Charlene Pemberton, and I'm excited to guide you on your financial journey. Whether you're looking to save, invest, or plan for the future, you're in the right place. Get ready for expert advice on budgeting, investment strategies, debt management, and real-life success stories that will inspire you to take control of your finances. Join me as we break down complex financial topics into easy to understand lessons, empowering you to navigate your financial future with confidence. Welcome to Navigating Your Finances, your trusted resource for mastering your money and achieving financial freedom. Hello, and welcome to Navigating Your Finances. I'm your host, Charlene Pemberton. I'm a financial educator, and I just have a passion for helping people do better with their finances. I hope that you have been listening in to our YouTube recordings because we've covered quite a bit for a while now. Things like spending plan, insurance basics. We had a good interview segment, preparing for tax time in 2006. We've talked about all things credit, and we just recently talked about get on the good foot and with financial tips for the new year. Today, we're coming back to you with just an overview of savings and investment basics. As we move through this, I just want to start by talking about the purpose of savings. And the purpose of savings is to prepare for future events like loss of income or deductible costs or deductible periods, and also to prepare for future purposes and minimize the use of credit, like for a car or a house or furniture, your big ticket items. As we talk about a purpose for savings, I want to just mention that one of the most important savings goals is that of an emergency fund, an emergency reserve. And the rule of thumb for an emergency reserve is 3 to 6 months of your monthly expenses. And why 3 to 6 months? Because in the event of a job loss, it usually takes 3 to 6 months to find a new job. And then also, if you talk about insurances, your deductible, in particular, if you talk about disability insurance, once you make a claim, it usually takes 3 to 6 months before you actually start getting paid the benefit. So 3 to 6 months of your monthly expenses will enable you to be able to keep yourself current financially while you are looking for a job or while you're waiting for a benefit to kick in. Also, when you're talking about savings, you want to use a high yield savings account. This is one thing I talked about during our Get on the Good Foot segment. Go to bankrate.com and you can find rates on higher interest rates, high yield savings accounts that will enable you to save and earn more on your dollar, even without a huge balance. There are many banks that offer high yield savings and do not require a minimum balance on the account. And then also with savings, consider using CDs, again, because you get a higher interest rate. And also when you're looking at saving, you're kind of looking at things that may happen within the year. So say, for instance, you're saving for a vacation, which is also another thing that you could put money aside for, as opposed to using your card for the entire vacation. If you're saving for a vacation and you know you're saving for next year's vacation, then you could use a CD that's a 6 month or a year-long CD so that you can get a higher interest rate on interest, higher interest return on the money that you're saving. So that's what that's really all about. And then you can save for car repair or car replacement. Car repair is expensive, you know. If you are, if you tend to drive an older car, or you tend to not try to buy a new car but buy a used car, as time goes on, cars wear, their components need to be changed. And so it's worthwhile to save for car replacement or particularly car repair. But also with car replacement, if you need to replace your car, then you can have a larger down payment on your new car, or you can take advantage of just using less credit. The higher down payment you have, the less credit you'll have to use for your car payment. And then the last area, if we talk about saving from a goal standpoint, possible thing is a real estate down payment. Um, if you get a conventional loan for a home, if you put down 20% or more on the home, then you can avoid the there's an insurance that you would have to pay if you put down less than 20%. So a real estate down payment is a good thing to save for. Okay, so that's just the purpose of goal savings and some of the possible savings goals you can have. And then I want to talk a little bit about why have even a goal-oriented savings. One of the key reasons is to prevent you from hoarding or feeding our greed. You know, we see a lot of in our world today of greed, people just trying to accumulate more and more just for the sake of having more and more. So when you save and you don't have a goal in mind, you can kick that greed look monster in us can kick in. And if we say with goals, we'll prevent ourselves from trying to hoard or just get money for the sake of getting money. So goal-oriented savings prevent us from hoarding or for feeding our greed. And then another thing goal-oriented savings um, enable us to do is to put our confidence in God and not in our money. When we start building money and we're building it for just the sake of doing so, we tend to put more confidence in the money and rather than trust in God. But if we have goals, we'll tend to manage that challenge within us. So one of the benefits of goals, one of a few benefits of goals is that goals provide direction for us. They enable us to stay in our lane. What I mean by that, if you have a goal set for yourself or for your family, and it'll prevent you from looking at what the person across the street is doing or when they got a new car, so then you want to go get a new car. If that's not a part of your goal or how you're being directed, then you can avoid that. Goals enable us, they provide direction for us, and they enable us to stay in our lane. We can be happy for the person next door, but we do not have to pivot and go after what they've done. Goals provide personal motivation. They help you to stay the course. When you talk about a goal, you're talking about getting from point A to point B. And when you talk about getting from point A to point B, we all know because of life, that might not be a straight line. Life happens, and there are different things that can get us off course. But if we have a goal in mind, we can be motivated to stay on course. Even if we're not getting to point B at the time we want to, we can make adjustments and keep our personal motivation even when things get blurry or things don't happen like we expect them to. So goals provide personal motivation. And then the third thing, goals clarify our thinking. The scriptures say, write the vision and make it plain. So, in line with that, one practical thing we could do, we're talking about goal oriented savings, we could do vision boards. I've understood that. I know of people that have had vision board parties. It's never too late to do that. Sometimes people do them at the beginning of the year, but vision boards are something you could do at any time when you are identifying a goal that you need to work towards. Um, they enable you to keep things creative and also to keep them in the forefront of your mind. Then, one other thing you could do, as we talked about in our segment on getting on the good foot, is to review and evaluate your goals and pivot if needed. Pivot may mean taking longer for getting, it also may mean that you'll reach your goal sooner. So just it's an idea of not just setting and forgetting, but setting and continuing to look at it at your goal and see what is it that you can do. What do you need to do? You continue it, you need to adjust it, whatever the situation. And clarifying your thinking helps stops you from getting frustrated. So reviewing vision boards, writing goals down will help you to clarify your thinking in the midst of life just happening. So that's about goal-oriented saving, some of the reasons you should do it, and the benefits of goal-oriented savings. So as we move from savings, we want to look at investing. And first of all, why you invest, and then I'm going to go over a few of the types of investments that you can consider. So investing is really about beating the rate of inflation, which is just the cost of goods and services. Investing is about having your dollar work for you as best as it could. And when you talk about investing, you really talk about preparing for goals that are beyond 5 years, especially if you're looking at getting into stocks or stock mutual funds, funds that may be riskier, but they will offer you a higher rate of return. So you want to have time to weather the ups and downs of the market. So when you invest, especially if you invest again in stocks or mutual funds, stock mutual funds, and even some bond funds, you want to make sure you have a time horizon for using that money beyond 5 years. I'm going to go back to the rate of inflation and the cost of goods and service to illustrate what I mean by the need, why you would invest. So, say for instance, right now, I don't know, a loaf of bread costs maybe $1 and something, in some cases two and some change. Well, years ago, it used to cost a lot less. So if you're just putting money aside in an account that's earning you 0.001%, and then the cost of goods and services are going up by 3%, you see the difference. Your money is not earning you enough to keep up with the cost of goods and services. Your dollar is not going to be worth much because, say, for instance, the average inflation rate is 3%. So what that says is if your money is not earning 3% or more, you're losing, and your dollar is even weaker than it needs to be. So you invest for the purpose of beating inflation. So then you want to try to invest to have um, a, a, a rate of 3% or more. And that's just an average inflation rate. There have been times when the inflationary rate has been high, much higher than 3%. So you want to at least be getting 3% on your money. And of course, if you invest, you want your endeavor is to get more. So you invest for the purpose of beating the rate of inflation. That's one of the primary reasons you might invest. So now that we've dealt with that primary reason, I'm going to step through at least 5 types of investments and give you some basics on them. We're going to revisit these in future recordings to look at the tax implications of them, especially when it comes to retirement or education investing. And so this won't be the first time that we'll take a look at these, but I'm taking a look at these just to give you a very basic idea of what these investments are. If you talk to anybody in the financial arena, you have heard these things before. So I just want to ensure that you know what they mean and what they are when you hear them being talked about. All right. So first I'm going to look at bonds. What are bonds? Bonds are an IOU issued by a corporation or a government. What they do, the person that purchases a bond, when you and I purchase a bond, we are loaning money to the bond issuer. Basically, bonds can be purchased from companies because they're borrowing money to help with building or, uh, purchasing something to help build their brand or build the corporation. And bonds are also issued by the government. You have municipal bonds, and perhaps one of the most popular type of bonds you will have is a U.S. savings bond. I think we're all familiar with those. So that means you are loaning money to the U.S. government, and the government is saying they're going to pay you interest on that money. So you're the buyer is loaning money to the bond issuer, and in return, the bond issuer is promising to repay your money with interest at the date of maturity, be it a year or 5 years, whatever the date of maturity, they're going to pay you back your money with interest. And a bond is considered a fixed income investment because the interest that's paid back is a fixed percentage of the amount you invested. So that's the basics of a bond. So when you hear a bond, you are loaning money to a corporation or government, and then they're making the promise to repay you that money with interest at the date of maturity of the bond. Next, I'm going to talk a little bit about the basics of stocks. Stocks, when you buy a stock, you are purchasing part ownership or you're purchasing equity in the company. The company may pay out part of their profits to stockholders in dividends. They may or may not. Not all companies pay out dividends. Some companies reinvest their profits. So when you buy a stock, you can get a return on income, that's your dividend, and you can reinvest that dividend, and you could also get growth or loss. So the income comes from the dividend that the company may pay out. You may get it in the form of a check. Sometimes people that are retired do that, or you may reinvest the dividend into the stock. Then when you talk about growth, as the company, growth comes from when there's an increase in the value of the shares owned. And then loss comes from a decrease of the values of the shares owned. There are tax implications to both. In growth, when you pull money out, and we'll talk about that, like I said, in a different segment. So then you can also benefit splits. benefit current owners, and that um, they benefit the current only owner in that if you have, say for instance, a stock splits, if you have one share, your share is multiplied by whatever the split number. If they do a, a 1 to 10 split, 10 to 1 split, then you own one share, but that one share also you will begin to own 10 times as many shares if there's a 10 to 1 split. And then the split also gives opportunity for a new owner to buy at a lower price. For example, Apple back in 2008, they did a 10 to 1 split. So then that afforded people to buy Apple. I think Apple was a pretty still probably $1,000 a share. So that decreased the share amount to $100. And so then people that wouldn't have bought at $1,000 a share took advantage of $100 a share to start investing in Apple. So like I said, stocks are part ownership in a company, and you can get gains through the return of income and also through growth. But stocks can also result in loss. Our next investment basic is mutual funds. Now, mutual funds are operated by investment companies, and it enables an investor to invest in many stocks or bonds. And the investment choices are made based on the objective of the fund. You can have growth funds, and most of their portfolio will be in the stock market. Also, you have um, different like international stock funds. You also have bond funds. And so those will primarily be invested in bonds. Um, One of the things about mutual funds, not only can you invest in many stocks or bonds at one time, but they offer, because you can do that, they offer investors diversification. You're not just putting your money in your one in one basket, your money in one investment, or that saying your egg in one basket. And then the other benefit is they offer you professional management. A mutual fund is usually being managed by a professional that's picking the investments that'll be a part of the fund based on its objectives, and they are very savvy at investing. Now, how will you know what in the world you're investing in and what's the objective of the fund? All of these things, these different things that you have to consider. Every mutual fund has a description document called a prospectus. The prospectus details the fund's objectives, the fees, the current holdings, and the percentage of those holdings, the customer services, the type of securities the fund may invest in, and the credentials of the current fund manager. And it is required by law that the prospectus is issued to an investor before an investment is made. If you're looking at investing in a mutual fund, familiarize yourself with the prospectus so that you will understand what you're investing in and who is managing the fund. That's the basics of mutual funds. The next thing I'm going to look at is investment index funds. Now, these are a particular type of mutual fund. They're mutual funds that are passively managed to mirror a specific market index like the S&P 500 or the Russell 2000 or some other indice. And they're usually less expensive. They're generally less expensive because they do not have an active manager. There's no human manager actively trading and making trade decisions on the fund. The funds automatically adjust to keep pace with the index is tracking. It basically mirrors the index and is designed to match the index performance and not beat it. So these are good buy and hold strategies, and like I said, their expense ratio is lower. They're less expensive. Let me just say it like that. They're generally less expensive than mutual funds that are managed by professional managers. Index funds are a popular way of investing, and you know what they're trying to do. Just mirror the index that they're trying to keep up with. Then the last investment basic I'm going to cover is annuities. And annuities are financial products that are sold by insurance companies to provide a guaranteed income stream. Annuities have two phases. They have an accumulation phase and annuitization phase, which is your payout phase. During the accumulation phase, when the owner is investing into the annuity. Then the payout phase, the income is paid to the owner based on the annuity payout agreement. And it's important that the investor, you and I, we understand the payout agreement before investing. There's some basic types of annuities. There's fixed annuities, there are variable annuities, and then there are immediate annuities. The fixed annuity during the investment period, they provide an investment that'll give you a fixed rate of return, like bonds, something. There'll be a fixed rate of return on the annuity during the owner's investment period. Then, with a variable annuity, it is going to give you a variable rate of return. Most often it's invested in the stock market, but so you'll get high returns, and you also probably have some risk, more than with a fixed annuity, okay? Then the last type of annuity is an immediate annuity. And what that is typically an investor will invest a lump sum of amount, and then the annuity will convert that to a guaranteed stream of income. So those are the basic types of annuities, and you have the basic types of investments of bonds, stocks, mutual funds, index funds, and annuities. Certainly, these are some of the types of investments that are talked about more frequently. And the objective here is just giving you an idea of what those types of investments are, so that when you're having conversations, you might not be an expert at it, but you have a basic idea of what those investments mean, what they actually are, what those types of investments are. So that's going to conclude our introduction to savings and investment basics. I hope that this has been helpful information for you. I hope that you will continue to listen, and also press the like button or subscribe to Generationally Speaking, which is my platform for sharing this information with you. Again, my name is Charlene Pemberton, and it's just my desire and my passion that we all do better with our finances. And so thank you for joining me with navigating your finances, and I hope to be speaking with you soon. Have a great afternoon. Don't miss out on valuable insights. Subscribe to our channel, hit the notification bell, and become part of our community dedicated to financial success. Let's embark on this financial journey together. See you in the next episode.